My call last week for $100 silver price, I don't think it's out of the realm. It's merely just more of a double from here. So I think we can get to see a triple digit silver price, and that would be probably a 5,000 or more gold price at the same time. This weekend in China, most people go shopping for gold. The malls are just full of people, young and old, taking their money and buying gold. She is a figurehead for Trump or an independent person.
I believe we are in a dangerous area, and I believe everyone knows that. Listen, I want to make sure you understand where we are in the world. When experienced gold supporters talk about Banana Republic, they're not exaggerating. It's remembering the past. In the early 1980s, countries like Argentina and Brazil had triple-digit inflation because governments put a lot of pressure on central banks to print a lot of money. The U.S. isn't there yet, but record-high budget deficits, $1.9 trillion in FY 2023, bear this out. When presidents put loyalists in charge of money, independence and trustworthiness fall apart. It's rare for that risk to be priced until it's too late. For investors, it's not enough to just hold gold. They also need to know when a policy's credibility is broken beyond repair. And what comes next shows how buying gold around the world shows that change happening right now. In China this weekend, most people are shopping for gold. Many people, both young and old, are shopping for gold and taking out their cash. If people in the U.S. can still go out, they borrow money to buy lots of things they don't need. The price of gold has been a great indicator of what's happening in financial assets, but Wall Street doesn't usually look at it because it's too dangerous for them. I believe the rise in gold for no other reason is important to look at, no matter if you're bullish on gold, mining stocks, or something else. And the fact that it's growing quickly and steadily here is a clear sign that the U.S. and other parts of the world are in for some very tough problems. As you say, it will be interesting to watch. Now we'll talk about gold. Yes, you are Peter Grandich. In 2023, people in China bought 630 tons of gold. Almost half of all jewelry bought in the world was bought online, and people in the U.S. had credit card amounts of more than $1.3 trillion. That difference is very noticeable. Chinese families are investing their savings in real estate, while Americans use loans to buy things they don't need. Gold is looked down upon by Wall Street because it shows how fragile financialized assets are, but the market can't ignore the fact that it's steadily rising above $2,000 an ounce. It's a sign of worry when gold goes up, even though real yields are high. It's not guesswork. This difference should show investors how disciplined people are with their money and culture. Next, we'll talk about how Fed policy distortions make these gaps even worse. We need to talk about the miners too, but first let's finish up on the Fed policy. This morning, Treasury Secretary Scott Bessent wrote an interesting new review that came out in the Wall Street Journal. That's what it is. It's an argument that the Fed's use of tools like quantitative easing has turned into an experiment that has escaped the lab, or gain-of-function monetary policy. I don't know if you've read it. He writes that the Fed should cut back on the problems it causes for the business. I guess my question is this: what are the biggest changes you see in the market because of this experiment, and how did they become permanent? But what he doesn't seem to want to focus on is Doge. If you remember, early in the government, there were videos of Trump and Musk talking on social media almost every hour about how Doge was going to not only fix and get rid of the deficits, but also pay down the debt. Gain of usefulness isn't just fancy words. It's a sign that monetary policy is now maintaining itself. From 2008 to 2022, quantitative easing added almost $8 trillion to the Federal Reserve's balance sheet. This changed the credit markets in ways that are hard to undo. Treasury's criticism points out the problems, such as lowered risk premiums, zombie companies that stay alive with cheap loans, and artificially high stock prices. At the same time, political stunts like saying that Dogecoin can help reduce the debt only show how policy is not as serious as populist gimmicks. The distortion question is very important for long-term investment. What happens when the lab project gets out of hand? The next part talks about debt overload and why printing money might be the only way to fix things. Where did all of that go? Instead, it turned around and went the other way. That means that after a certain amount of debt, governments or whoever is in charge, the Federal Reserve or someone else, can only print money because the other option is hardcore deflation. This country has been through a depression before, and it was much worse than an inflationary crisis. So I just think that whatever takes the place of the Fed, if it's going to be led by someone else with different ideas, then printing money will be their only tool at the end of the day. That's another reason why gold is reacting this way. People know that, and they know that in the end that will be very bullish. This is especially true since growth is still happening in the world, mostly in Asia, and many of those people are joining groups, especially the BRICS, to stay away from the US and its currency. The percentage of U.S. debt to GDP is now 123%, which is the highest it has been since World War II. And history shows that once debt saturation happens, it's hard to get back to being fiscally responsible. Policymakers have to decide between a deflationary crash or inflation by making more money. Due to scars from the Great Depression, deflation is not a choice that can be considered politically. That's why gold moves. Markets know what will happen in the end. Meanwhile, the BRICS countries are increasing their gold stocks quickly. China alone will add 225 tons in 2023 as an open way to protect themselves against the dominance of the dollar. Investors should keep a close eye on these trends. They show what politicians don't want to say. The next part is the blunt ending. What this means for the role of the U.S. dollar. The end of the U.S. dollar has been talked about for decades, and this is the last step of that talk. We're in that now, and you'll see that whoever takes over, whether they're just a Trump supporter or someone who stands on their own, will just print money and make the dollar worth less. And that can only be good for gold. It has been interesting to watch the price movements over the past week. Are you a little worried about how the prices are moving? When I talked to other experts, they told me to slow down and take a deep breath. What do you think? Okay, Jeremy, here's the story I want to tell you. It's worth your time. In the early 1980s, when I started working as a financial manager, almost 2/3 of the people who work today hadn't even been born yet or were still in diapers. At the time, no one knew who said that the Dow would go to $3,600. It might be too dramatic to call this the end of the dollar, but the dollar's status as a reserve currency is already being eroded. In 1999, the dollar made up 71% of the world's savings. By 2023, it makes up only 58%. The numbers won't change if the political leaders change. The debasement of the currency is needed to fix ballooning debts. This week's rise in gold prices isn't just due to technical factors. This fundamental decline can be seen in it. When analysts tell people to be patient, they might not be taking into account the fact that once trust is lost, changes rarely happen slowly. Long-term buyers need to think about this in light of their holdings of dollar-denominated assets. Next is a story from the past that shows how market goals that seem impossible can sometimes be reached faster than thought. His name was Robert Preckler Jr. The Elliott wave theory was his idea. At the time, people thought he was crazy because the Dow had been trading between 700 and 1,000 for 13 years. In fact, a well-known magazine put our business, Equities Are Dead, on the front page. People laughed and scoffed and said, listen, this 3,600, we can't get to 30. We can't even get over 1,000. We all know it went a lot farther after the 1930s. Traders in a range have been stealing gold in the same way for many years. Okay, finally reached 2,000, the number we talked about. There is no way that 5,000 and 10,000 can happen, just that it's too much, especially in the time frame some people are talking about. That was the same way of thinking they had back then. Though it doesn't mean it will happen, the fact that it has moved in that way doesn't mean it can't keep going. People didn't believe Robert Preckler's call for a 3,600 Dow in the early 1980s, but the index went on to rise above 36,000. People still think that way about gold. It's just dead money until it quietly breaks through obstacles. Prices of gold fell between $1,100 and $1,900 from 2011 to 2020, but they finally broke through $2,000 in 2020. When ranges settle, momentum can catch even experts off guard. No prediction is 100% accurate, but completely ignoring $5,000 or $10,000 goals doesn't take into account how cycles and mood often go beyond what is expected. The real question isn't whether it would happen or not, but what would make it happen. Next, he talks about how gold sideways summers might lead to those big runs. There will, of course, be times like the one we just went through. I had a dream come true this summer. For the whole summer, I said prices should stay flat to let moving averages catch up. That would set the stage for gold to reach $4,000, or now have it. That's right, very, very short time. You deal in goods, I do not trade. I can't. It's easy for me to count on one hand how many traders have ever made money, but I think the only thing that makes gold more expensive is investing in it over time. Okay, so 4,000, that 5-10 call, is that kind of outside the realm of your thesis? What the hell do they know? It's not, though. You don't want to see anything, right? Is there anything Pete Brand, who is a gold bull, doesn't want to see? Please don't call me. We just hit $10,000 gold. In 6 months, if God wills it, please ask Pete to come out and talk about it. Most of the time, traders don't like sideways consolidation, but long-term buyers love it. The summer chop in 2023 brought gold's 200-day moving average closer to the price, which lowered the risk of a drop. Bases like the 18-month break before the 2019 breakout have led to runs worth thousands of dollars in the past. Traders may want to make quick flips, but the odds of winning are low. Institutions make decisions based on cycles instead of days. To be safe, a quick rise to $10,000 would probably mean a systemic disaster, not healthy growth. It's better for investors to wait for stair-step rallies than to pray for vertical spikes. Silver's rise from a second-best choice to a real money-making contender is coming up. What would have happened in the world if we hit it that soon, or in such a short amount of time, would be much worse than what we're talking about now. Yes, do you have any silver, Peter? I mean, let's get into it more. Gold gets all the attention, but silver just hit its highest level in 14 years, and its all-time high of around $50 is now within reach. What do you think? Does silver just follow gold, or does this price action tell us something different about the flight to safety and the hope of industrial use? Every job I've had up until a few months ago, silver was always better than gold. It was below 30 this year, though, so I took the time to really listen to a few smart people. Some of these people don't always say that silver is going to the moon, and they made a very strong case that was better than any other. The 14-year high for silver isn't just gold's shade. It's a story about how money demand and industry scarcity meet. Unlike gold, half of silver's use is in industry, like in solar panels, electric vehicles, and technology. The Silver Institute said that the world's desire for silver reached a record 1.2 billion ounces in 2022, leaving the market short by 237 million ounces. That is the truth that is often forgotten about the price increase. Silver was looked down upon for decades, but structural gaps have changed it into a very different asset now. If investors don't pay attention to this change, they might miss the driver of both safe haven and industrial utility. Next, he talks about why silver's fundamentals may now be as strong as gold's. So I decided that silver could now be on the same level as gold. After I bought it, I also decided that I could sometimes be ahead of gold. In the 41 years I've been working on it, I think this is its best big idea. Also, don't forget that everyone is talking about the old Hunt high, which was about $50. Based on when that was made, we'd need to get to almost $200 to make it worth the same today. That's why I called last week for a $100 silver price. It's not impossible, in my opinion. From here, it's just more of a double. So I think the price of silver could reach tens of dollars, and the price of gold could reach $5,000 or more at the same time. That's really strange. In a rising market, silver does add to the idea that gold is like steroids. And it's clear that we're seeing that high. What does that mean for the amount of gold to silver? When prices are adjusted for inflation, the 1980 Hunt Brothers high for silver would be close to $200 today, but the markets still see $50 as the top. Given structural deficits and rising industry intensity, that price difference is very strange. A gold price of $100 for silver only means a doubling, not a bubble. Also, correlations are important. During late-stage bull runs, silver often moves faster than gold. This brings the gold to silver ratio down from over 80 to around 40. If gold goes above $5,000, silver hitting $10,000 is not just a fantasy, it makes sense analytically. One idea that is often missed is that silver may lead, not follow, when financial panic meets manufacturing stress. Next, he explains why ratios are not as important as the overall direction. I haven't been caught up in that since I became strong on it, because things change all the time. Of course, there's no need for that. The mean opposite should happen when there was that much of a difference. But right now, I think they're going to run 1-2, and sometimes one will be ahead of the other, but they'll both work their way up. Okay, let's move on to mines. So it makes sense to start with silver miners, which often offer even more power. It's an extremely volatile area, and you can see these huge jumps like we have. Peter, let's bring it back. To put it another way, what should buyers think about silver miners right now? Is there a better risk-reward scenario than gold miners, or is the fact that they are also factory workers an extra risk in an economy that is already slowing down? It's the cash flow that makes you rich, not the ratios. Silver miners have a lot of upside, but they also have a lot of business risk, which is made worse by price changes. Unlike gold workers, people who work with silver have to depend on the economy as a whole to make money. Margin can be capped even when the market is rising. Having that much change can go both ways. In 2020, main silver miners did better than gold peers by almost 2x during the rally, but they fell more during the correction. For investors, this is not a case of risk versus return that involves spreadsheets. The smart move is to spread your money out rather than going all in on one bet. His next thought is about silver miners versus a gold-copper approach that is becoming more popular. They were possibly the second or third choice I made. When people think of silver mining, they should keep in mind that for many years, silver was mostly just a result of the mining business. It wasn't stressed enough, it didn't cost as much as the other metals, but because it seems unique, and is making a strong basic case on its own, some people might just want to find people who can get them the silver. China does that. We know that. In the end, they are something to look at. Anyway, I believe the best metal mix right now is gold and copper. Even some of the biggest names in the mining business, Barrick being the most vocal, say that they are focusing more and more on copper and gold mines. That might be good. That's because gold has become such a strong currency. For a long time, silver workers were not very important because most silver came from mining-based metals. But China's clear actions to protect its silver supply show that it has a plan, not just a hunch. That's why it's not smart to ignore silver miners at all. Still, big names in the industry like Barrick are shifting their focus to gold-copper projects, which is a clear sign. Copper's job is to make electricity, and gold's job is to protect money that Wall Street doesn't give enough credit to making a dual hedge. Investors should wonder why miners are moving their money around if silver has such a good story. The answer shows where the real belief of the company lies. The last point ties all of this together. Why copper and gold may be used first to anchor stocks can help them pay the higher costs of developing a copper mine. That's why I would look at gold and copper first, then gold by itself, and maybe silver right behind it. Those are the top metals right now. Of course, if you want to get into important mineral fights about metals I can't even spell, let alone pronounce, there will be a lot of people interested. But my main focus is on the gold, silver, and copper markets. While lithium and rare earths get all the attention, miners are actually more interested in gold and copper. The reason is simple. Copper has high initial costs, but gold revenues balance out the risk. Gold funds the project, and copper powers the future. This is why companies like Barrick and Newmont are openly shifting their attention to dual resource deposits. For investors, this means that chasing trendy metals might not be the best long-term plan. Instead, they should focus on the pair that drives both financial and industrial demand. Silver is still useful, but it's not first or second.